Picture this. You wake up in Lisbon, sip coffee on a tiled balcony, and end the day in a busy Berlin beer garden. It's beautiful, but something feels off. The streets are full of older faces, and many shops are run by foreign companies. In cafes and parks, Europe's energy seems dimmed. You could almost sense something is wrong in the quiet of those sunny squares and parks. You see the same pattern in the data. Europe's growth simply isn't booming. Growth is where the truth shows up. GDP only measures output. It doesn't care about political speeches or national pride. It's not that Europe is falling apart, but it is being squeezed. When growth slows, you feel it in everyday life. Factory lights stay off longer, families delay a second child, and job openings vanish. Today, I'm breaking down 5 reasons Europe's economy is struggling. What's happening, why, and what would need to change? This isn't a political rant, it's just the facts as I see them. Quick note: comparing EU and US GDP in dollars can mislead. When the euro was strong, the EU's GDP in dollars looked big. When the euro fell, it looked smaller. Experts warn against reading too much into one number. Instead, let's focus on the pressures you can feel in factories, budgets, and daily life. Energy costs are sky high. Energy is like oxygen for the economy. When it's cheap and reliable, things run smoothly. But when energy prices soar, the whole system feels the pinch. For a factory, the effect is brutal. It runs 24/7 and can't just shut off because electricity is expensive. If European factories pay 2 or 3 times more for power than similar factories elsewhere, their products suddenly cost a lot more. Customers will then buy from whoever is cheaper. In short, high energy bills kill jobs and scare away investment in energy-intensive industries. This isn't hypothetical. Reports have shown that at times in recent years, factories in parts of Europe paid up to 5 times more for energy than American factories. For an energy-hungry industry, that gap is a death sentence. It explains why some factories slowed production or even moved abroad, and why investors steered clear of power-hungry businesses in Europe. For families, it meant record gas and heating bills. For steel mills and chemical plants, it meant shutting down furnaces on cold nights. So how did Europe end up here? It's a mix of factors. Europe depended heavily on natural gas, even from Russia, phased out coal faster than some other places, and hasn't fully replaced it with reliable alternatives. When the Russia-Ukraine war cut off gas supplies, Europe had to scramble for LNG on the world market. Buyers in Asia and elsewhere simply paid more, driving up prices for everyone. At the same time, building enough wind, solar, and other renewables takes years and massive investment. Europe didn't transform overnight. The result was higher bills. People noticed, and governments responded with subsidies and price caps to help households. Those measures eased pain temporarily, but hurt budgets and delayed deeper reform. My take: Europe can't fix growth without fixing its energy reality. You can talk about tech or taxation all you like, but if factories can't afford reliable power, other solutions won't matter much. Europe and its countries need a clear, pragmatic energy plan. Keep pushing renewables and efficiency, but also ensure enough stable power now. That means coordinating gas purchases as a bloc, building more LNG terminals, and upgrading the power grid faster. Give industry long-term power contracts or price guarantees. If heavy industry truly needs lots of firm power, governments should set clear rules, for example, allowing some nuclear or hydrogen as a bridge during the transition. Above all, create predictable energy policy so businesses can plan long-term. Unpredictability kills investment. Demographics: fewer young people. The second big problem is demographics, and this is just math, not politics. Europe simply has fewer young people and more retirees than before. When fewer people work and more people retire, output falls and tax revenue shrinks, even as costs for pensions and healthcare rise. In practical terms, that means slower growth, tighter government budgets, and more pressure on the working population. For example, a large share of government spending already goes to pensions and healthcare. More retirees would push that even higher. Italy is a clear example. In 2024, there were only about 70,000 births, and Italian women had, on average, just 18 children each, far below the 1 needed to replace the population. That's not a blip, it locks in a shrinking workforce. Many European countries face the same issue: birth rates below replacement level. Now, imagine you're 25 in such a country. You look ahead and see heavier taxes and fewer public services per person. Housing remains expensive, and many jobs feel secure but aren't multiplying. Do you stay and shoulder that burden, or move to a place with more opportunity and higher pay? It's a gut-wrenching choice for millions of young Europeans. If lots of young, talented people emigrate, the country loses not just workers but also creativity and future entrepreneurs. Each person who leaves takes skill and energy with them, adding to the economic drag. Europe can push back in two ways: help families and smart immigration. That means making it easier to have and raise children, affordable childcare, strong parental leave, and housing support for young families. It also means bringing in skilled immigrants to fill labor gaps. Some countries give cash bonuses for babies, but those only nudge the birth rate a bit. The real goal is lowering the lifetime cost of raising children and integrating new workers. For example, Sweden and France have generous family policies and higher birth rates than much of Europe. The choices people make about family and career are key to solving this problem. Industry is losing its edge. Third, Europe's industrial base is under pressure. Europe got rich by making things: cars, machinery, chemicals, ships, airplanes. That manufacturing base created good jobs and big exports. But manufacturing is unforgiving. If your costs rise, companies move production to cheaper ground. Today, Europe's costs are rising. We've already seen the impact of energy. Add to that higher wages in some countries and a web of regulations and paperwork. All this makes parts of Europe less competitive than, say, the US, China, or Southeast Asia. Germany shows this problem clearly. For decades, Germany's strategy was export-driven manufacturing, first-rate vocational training, and tight supplier networks. It worked brilliantly, but it assumed cheap energy and smooth trade. When those assumptions broke, with high energy prices, supply shocks, and rising global competition, cracks appeared. Factories started slowing, delaying new investment, running shorter shifts, or even moving capacity abroad. When industry slows, you can't replace those factory jobs overnight. Europe has service and tech sectors, but they often need different skills and ramp up more slowly. The result is a gap: fewer factory jobs and not enough new jobs in other sectors to fill them. Innovation and tech scales struggle. Because manufacturing growth has weakened, Europe looks to innovation to drive expansion. But Europe has a harder time scaling up. Speed and scale are everything in tech. Europe has plenty of talent and bright startups, but turning them into global giants is tougher here. The challenge is fragmentation. Europe is 27 countries with different languages, tax codes, and regulations. A startup in Berlin that wants customers in Madrid or Rome has to navigate each country's rules. That slows growth. European investors also tend to be more cautious and have smaller funds than American venture capitalists. Contrast that with the US: one big market, one legal system, and enormous venture pools. A US startup that takes off can quickly serve all 300 million Americans. A European startup with a great product may roll out slowly, country by country. Even a delay of a few years can be a huge disadvantage in tech. The EU has tried to harmonize some rules, for example on digital markets and data, but progress is slow and uneven. Often, companies wait for approvals or get stuck in red tape. In tech, momentum is everything. If Europe's ecosystem moves more slowly, it loses market share to faster competitors abroad. The bottom line: Europe creates a lot of great tech, but fewer 100 billion unicorns. That means less economic growth from the tech sector than you might expect. Where's the money? Capital markets and investment culture. Finally, look at where the money is. In strong economies, a lot of household savings flows into businesses. In the US, roughly 58% of households own stock or equity funds, often through retirement accounts. That means a huge pool of US saves is chasing startups and growing companies. Firms must compete for that capital, and investors push them to expand. In Europe, far fewer households invest in equities. For example, only about 18% of Germans owned any stocks or equity funds in 2023. Most people save in bank accounts or buy real estate. This means less homegrown money to fund startups or industrial expansion. Politically, it has effects too. When more people own stock, they tend to support pro-growth, pro-risk policies, since their wealth is tied to companies' success. When more people play it safe, there's less pressure for bold reforms. For example, US. Retirement plans like 401ks often invest heavily in the stock market, giving many Americans a personal stake in companies. In Europe, however, many retirement funds go into government bonds or savings accounts, so fewer citizens directly benefit from corporate growth. The result is a vicious cycle. Weaker growth leads to lower returns, which makes people invest less, which leads to fewer big success stories, which sends money into safe assets or overseas. Without local winners to invest in, entrepreneurship suffers and markets stay shallow. The problems are stacked. Step back and the picture becomes clear. Europe's challenges stack on top of each other, like weights on the legs of a runner. Each problem is an extra weight dragging the economy down. High energy costs squeeze industry. A weaker industry means fewer jobs and less investment. A shrinking workforce means fewer workers and taxpayers. Europe then depends more on tech and services to grow, but those are slowed by fragmentation. And shallow capital markets mean not enough funding to lift any sector. Each issue feeds into the others. Addressing just one won't change much. Europe needs to fix several layers at once. What could change? Real solutions. There's no magic switch, but here are some realistic steps that could move the needle. Energy. Take a pragmatic, all-of-the-above approach. Keep building wind and solar and improving efficiency, but also secure enough reliable power today. Coordinate natural gas purchases as an EU bloc, build more LNG terminals and upgrade the power grid. Provide industry with long-term power contracts or price guarantees. If heavy industry truly needs baseload power during the transition, governments should set clear rules, for example, allowing some nuclear or hydrogen as a bridge. Above all, create predictable energy policy so businesses can plan long-term. Unpredictability kills investment, families, and workforce. Europe needs more people working. Make it easier to have and raise children. Affordable childcare, strong parental leave, and housing support for young families. Invest in education and training so young people can get good jobs. Reform immigration to bring in the skilled workers Europe needs. Cash bonuses and tax breaks for babies help only a little. The real goal is lowering the lifetime cost of children and integrating new workers. For example, Sweden and France have generous family policies and higher birth rates than much of Europe. The choices people make about family and career are key to solving this problem. Manufacturing fundamentals, fix the basics rather than picking winners. Keep energy and transport costs competitive. Invest in vocational training and apprenticeships. Germany's apprenticeship system is a great model. Strengthen supply chains and ensure access to materials. Make the total cost of doing business in Europe predictable and fair. Investing in infrastructure, from ports to broadband, is also part of fixing the fundamentals. When companies trust the business environment will stay stable, they'll be more likely to invest and hire. Scaling and innovation. Break down barriers so startups can grow big. Harmonize digital and data rules across the EU so a company can serve the whole market easily. Simplify cross-border investing and fundraising. Build larger capital pools, for example, Europe-wide pension or investment funds that put money into startups. Accelerate completion of the Capital Markets Union so firms can raise money continent-wide. Encourage public markets and investors that reward long-term growth rather than short-term gains. Investment culture. This is a tougher shift, but policy can nudge it. Offer tax advantages for retirement accounts that invest in European equities. Improve financial education so people feel confident owning stock. When more citizens have a stake in growing companies, they'll support pro-growth policies and tolerate some risk. Politicians will also feel pressure to create a friendly business environment if their constituents' savings depend on it. For any of these changes to succeed, predictability is key. Businesses and families need to trust that rules won't flip every election. Policymakers should give clear, long-term roadmaps for policy. Uncertainty is one of the economy's biggest enemies. 2 possible futures. Which way will Europe go? One path is incremental, slow, cautious reforms and steady subsidies to cushion pain. Heavy industry would gradually drift away. Growth might stay mildly positive, but it would be slow. It's not collapse, but it's no leap forward either. The other path is bold reform, coordinated action on multiple fronts. Imagine industries getting cheaper power for the next decade in exchange for steep emissions cuts. Imagine EU-wide apprenticeships and research programs pumping up skills. Imagine European pension funds pouring more money into local startups. This path won't be easy. It might involve short-term sacrifices like higher taxes now, but it could restore competitiveness and much stronger growth in the long run. For anyone investing or saving, the logic is clear. If you want fast growth, the US often looks better right now. America still has more of the fast-scaling tech companies and deep capital markets. That's partly because many Americans own stocks and push the economy forward. Europe has had fewer 100 billion tech champions to attract such investment. Over time, if Europeans insist on growth, you'd likely see more domestic investment in homegrown companies too. Europe isn't stuck because of one bad decision. It's being squeezed from 5 sides at once: expensive energy, fewer young workers, industry under strain, tech that scales too slowly, and not enough money flowing into big new ideas. On their own, each problem hurts. Together, they quietly drain momentum from daily life. But here's the part people forget. This story isn't over. Europe still has talent, strong institutions, and the ability to rebuild. If leaders stop pretending, if countries work together, and if everyone accepts that real change costs something up front. If Europe chooses long-term courage over short-term comfort, growth can come back, and so can that be feeling that the future is getting bigger, not smaller. If this made you think differently, share it with someone who cares about Europe. And tell me in the comments, what do you think Europe should fix first?